Welcome to Fraser Heath's How With-Profits Fund Management Can Diminish Returns. The mix of investments in your portfolio, the asset allocation, is a key factor that influences the reward and risk of your investment. So you want your fund manager to manage investments in a way that will maximise the risk and reward. But maximising investment returns is not the main factor that influences the mix of assets in a with-profits fund. And this video explains what really influences the mix of investments and how this process can cost you money. A with-profits fund is actually a company. It's got assets, which are the value of all premiums ever invested by policyholders. And it's also got liabilities, and these are the value of all guaranteed values made to current policyholders. When the value of the assets comfortably exceeds the value of the liabilities, the fund can afford to invest in volatile assets like company shares. But when the value of the investments start falling, the company gets concerned that the liabilities may soon exceed assets if values fall further, and so they reduce their exposure to volatile investments like shares. Let's take the Aviva XCGU fund as an example. At the end of 2007, when the world economy and investment markets were strong, the fund had reasonable exposure to shares, about 53% of the fund. By the end of 2008, just after the credit crunch, the percentage of shares had reduced markedly. It was down to just 38% of the fund. Things got worse in spring 2009. Aviva had sold even more shares, only 30% of the fund in shares. Then the stock markets recovered, asset values were back up again, and Aviva ended 2009 much like they started, with 39% of the fund in shares. So does this really matter? Was any harm done? Well, the performance of Aviva's with-profits fund in 2009 suggests these changes diminished returns. The performance suggests this liability matching meant that they sold shares cheaply at the bottom and then bought back when the strain of liabilities was not so great, but of course by that point shares were more expensive. Just take a look at Aviva's cautious managed fund, generated a 10% return in 2009. Their distribution line fund, another cautious fund, 20% in that year. Their with-profits fund, just 6%. With-profits fund management can diminish returns. Is your plan right for you? Contact Fraser Heath today for a free with-profits consultation. Our head of with-profits research, Miles Hendy, a chartered financial planner and expert in with-profits, will talk you through the main issues to consider. Call me on 01454 327788. Visit our website with-profits.com. Here's all this morning. If you have a with-profits fund, please get in touch. I'd love to hear.